Hello, folks. Charlie Gipple here, the CEO of CG Financial Group. Today, we're going to have some fun. Today, we're going to take a tour of the long-term care insurance world. Now, to segue into that, I'm going to pull up a slide here. This is a subcomponent, what I'm going to talk about at the financial professional level. This is a subcomponent of my Avoiding the 7 Retirement Traps presentation. I have two types of presentations. One is towards the consumers. And by the way, last week, I did for the agents of CG Financial Group, I did for their consumers across the country. I did this presentation where I talk at the consumer level about the 7 retirement traps, the 7 traps that can derail their retirement. And it was very heavily attended. I was quite surprised that it was so heavily attended. And as we speak, the agents are getting follow-up calls from the consumers because I directed them back to their financial professionals. But the first of the 7 traps, which is the topic of conversation here today that I'm going to talk about, is the long-term care risk. Actually, it's the potential solution to the long-term care risk, and that is a tour of the long-term care insurance world. And this is, again, the agent module or the financial professional module, to where I share this slide. I would never share this slide with consumers because, well, it's getting way too detailed, right? But here's what I want to talk about, because there are a lot of misperceptions when it comes to long-term care insurance, the various types of long-term care insurance. For instance, I hear every week how agents use linked benefits and combination products synonymously. Linked benefits and combination products is basically being the same thing. That's not so. If you are a combination product, that doesn't necessarily mean you're a linked benefit product. If you are a linked benefit product, yes, you are a combination product. In short, linked benefits is a country within the world of combo/hybrid products. Now, first of all, what do we mean by combo products? Well, a combination or a hybrid product, which that is synonymous, combo or a hybrid product, what that's referring to is a long-term care benefit. A long-term care benefit being attached to something like an annuity chassis or a life insurance chassis. And really, there are two primary, again, countries within that combo hybrid product world. And those two areas are just the acceleration of benefit area, which you see there on the right-hand side of my combo area. But then the left-hand side is the linked benefit country within that combo/hybrid world. We'll drill in a little bit here, but in short, if you're a linked benefit, yes, you're a combination product. If you're a combination product, you may not be a linked benefit, right? So let's dig in, start from the left-hand side. Traditional long-term care insurance. This goes back to the late 70s, early 80s. This is now only about 20% of the cases written industry-wide, at least based off of the 2019 Milliman study that would have looked at 2018's numbers. I don't think my friends at Broker World have published the 2020 Milliman study yet. It's probably not even out yet, but when they do, I'll be doing a special webinar talking about the details of the 2019 sales. But in 2018, 20% of policies issued within the long-term care insurance space were traditional long-term care insurance. Again, traditional long-term care insurance was 100% of the world at one point in time, the long-term care insurance world. What have been the concerns, whether rightfully or wrongly, what have been the concerns recently with traditional long-term care insurance policies? Well, really two different areas that I talk about a lot. And I'm going to talk about how I believe these companies have righted that ship, so to speak. The first concern that consumers have had with traditional long-term care is premium increases, massive premium increases, right? Upwards of 100% premium increases. Why is that? Why is that? Well, the late 90s, early 2000s, long-term care companies were pricing these products, and probably rightfully so, because who would have known, right? They were pricing these products assuming that when the consumers put their premium into the insurance company, who then invests it in their general account, who would have thought that those general account yields would have continued to decrease like they have over the last almost 4 decades? 1981, the 10-year Treasury was paying almost 16%. Today, actually yesterday, 60% basis points. Who would have ever known, right? So as a result of that, premiums had to go up, because if the insurance company is supporting a future value, well, in order to support that future value, if you're getting less of an interest rate on the money going into that general account, well, the present value has to go, the premium has to increase, right? So that's what happened. Premiums also increased, just as importantly, because of lapse assumptions. You know, from a monetary standpoint, it does accompany good from purely a monetary standpoint when people pay premium for a certain number of years and then they stop paying that premium. They lapse a policy and say, yeah, I don't want this after all. And I know I'm not going to get a benefit and I would have wasted my premium, but I changed my mind on that. Well, lapse assumptions of anywhere from 4% to 6%, you know, that's what a lot of these carriers embedded into their policies. Who would have thought that consumers would not have lapsed their long-term care insurance policies? Well, that's effectively what happened. I've heard true lapse experience of less than 1% on a lot of these policies. So as a result of that, again, premiums had to increase. The fact that these people were pretty much all going on claim because they did not lapse their policy, to speak a little bit exaggeratively, I guess, if that's a word. So that's the first concern. The second concern is if I don't use it, I lose it, right? I pay premium in traditional long-term care. If I don't use it, I lose it. If I just pass away without using it, then it goes nowhere, right? I wasted my money. And that's feasible. Both of those concerns are very feasible. I'm not saying it's not, right? But here is where I think that a lot of the companies, traditional long-term care insurance companies, in which I love traditional long-term care, it provides the most leverage, for the most part, it provides the most leverage of any of these options up here on the screen. So how have a lot of these companies righted that ship? Number one, some of the traditional long-term care insurance policies have return of premium provisions that the consumer can elect. And number two, regarding the premium increases, lapse assumptions today are a heck of a lot different. Lapse assumptions and interest rate assumptions are a heck of a lot different than what they used to be. And as a result, I think you have a level of price stability that these companies did not have, unbeknownst to them, say 20 years ago, 15 years ago. So that's traditional long-term care, around 20% of the overall long-term care insurance universe. I don't know if I mentioned this yet, but there may be another couple of subcomponents here, but to talk about those subcomponents would effectively be like splitting hairs, because this is a huge majority, if not all, of the long-term care insurance world here. So now let's skip over the traditional long-term care and go over to life insurance with accelerated death benefits. So an AOB, or an acceleration of benefit rider on a life insurance policy, for instance, that makes that life insurance policy, that makes it a combo/hybrid product, right? And within the life insurance space, you really have two primary types of riders: long-term care riders and chronic illness riders. Now, a couple points on this area here. Once upon a time, long-term care riders were a lot different than chronic illness riders than what they are today. The similarities are more, it's more of a gray area today versus black and white. For instance, up until a few years ago, almost all of the chronic illness riders had the trigger of you the client, you the insured, cannot do two activities of daily living permanently. You have to be impaired permanently, or severe cognitive impairment, which in and of itself is permanent. And I won't get into the way that, the compact states and the filings and what all progressed, but long story short, that was the case up until a few years ago, probably, I would say 5 years ago, 2015. I'll just throw that out there. Correct me if I'm wrong, but up until then, that's when I started to see things change and some additional, changes to some previous regulation. Well, how is that different than what the long-term care riders were at the time and still are? Well, long-term care riders, the trigger was a lot less onerous, as in you cannot do two activities of daily living for 90 days. And if a doctor can certify that, then you get access to your death benefit. You don't have to die to get your death benefit because you can accelerate that death benefit. This is life insurance, not death insurance, right? The new type of life insurance many times is life insurance, not just death insurance. So that was a big difference up until, again, about 5 years ago. temporary condition would trigger the benefits, and then a permanent condition was required right there. So that was the difference between long-term care and chronic illness. Today, pretty much any chronic illness that I know about, any chronic illness rider requires 90 days, 2 activities of daily living, or severe cognitive impairment. So again, that's a little more of a gray area there. A point on free. A point on free benefits here. What do I mean by that? I mean, a lot of the long-term care riders do not cost the clients anything between now and the time that they have to use the rider. In other words, Mrs. Client, you get access to 100% of your death benefit, and you do not have to pay anything for that rider to be on the policy. And that is 100% true, but that is different than being quote unquote free. By the way, there are some chronic illness riders that do have an embedded morbidity fee. Those obviously, there are a cost. There are an additional premium requirement, right? But a good chunk of the chronic illness riders do not have a cost until the client uses it, which means it would not be quote unquote free, right? Now, the way that that may typically work is through a discount structure. And a lot of even financial professionals aren't aware of this. Yes, it costs nothing to put that chronic illness rider on the policy. With most policies, it's actually already included. But what happens when the client goes on claim when they're, say, age 70? Well, a structure may look like, hey, Mrs. Client, you can take 2% of the death benefit out per month, which means that that death benefit, your $100,000 death benefit, would be fully depleted, fully paid out, fully accelerated over a 50-month period of time, right? Well, then did that client get cash in hand? If they did do that, cash in hand of all of their $100,000 death benefit? No, they did not. It was not quote unquote free, right? Because what they would get is maybe say, you know, if in month 1 the client accelerated from the death benefit, say $2,000, maybe that client only got $1,500 cash in hand. Well, where did that $500 go? Well, that went to the company through that discount design, right? So anyway, many times that discount, the calculation is based off of, okay, if we, the company, are going to pay the death benefit out early, then what is a present value calculation of that death benefit, discounting it down to the age that the client is today versus, say, what we priced into the policy as being their true, you know, when we were going to pay out the death benefit. So free is not necessarily free a lot of times. Now, the benefit to that discount design is if the client doesn't use it, they don't lose it, right? They never paid anything for that. So that's a big benefit to that. Now, so as I said right here, this area of the hybrid world, 100% of the death benefit is a maximum that one can take out. So that client at the end of 50 months, if they took that 2% per month, they're done with many of these policies, right? Interlinked benefits. Here is the difference between linked benefits and just an acceleration of benefit product. Linked benefits have what's called an extension of benefit rider or a continuation of benefit rider. Different companies, different vernacular, right? And what it says is, okay, so that life insurance policy, Mrs. Client, that you had, what if, when at the end of that 50-month period of time, what if, even though the death benefit's gone, nobody's going to receive anything when you die, the cash value is gone, what if, Mrs. Client, you could continue that $2,000 a month, just using my example, for another, say 50 months? Or lifetime. There are some companies out there that will say, we will extend your long-term care benefit if you're confined to a nursing home for lifetime, for another 50 months or what have you. A benefit that is extended past the client's actual death benefit, that is a linked benefit. That is an extension of benefits rider. That is a continuation of benefits rider. And it is because of these EOBs and COBs that an AOB product becomes a linked benefit. So again, if you have this product over here, acceleration of benefit product, but then attach onto the back end an extension of benefits, even after the base policy is depleted, that is what makes linked benefits. And obviously that will give the client more long-term care coverage, typically more long-term care coverage than over here. So you have two different designs: life insurance linked benefits. The beauty of that is let's say a client wants to put $100,000 in. Maybe they have a death benefit of $200,000 immediately. And by the way, if they die immediately after putting in that $100,000, is it, if I don't use it, I lose it proposition? No, it's not, because the beneficiary is getting $200,000, right? But again, if they put in $100,000, then maybe that means that $400,000 or $500,000 is the total long-term care pool spread out over that X number of months, 100 months or 66 months or lifetime. There's a company out there that provides lifetime benefits, one of my favorites, and you know who you are. Many of you know who they are if you're listening to this. So that's life insurance linked benefits products. Annuities linked benefit products. Now, of this right here, life insurance with linked benefits, traditional long-term care, as well as just the acceleration of benefit products over here. Underwriting, the least amount of underwriting, which is usually done via just knockout questions and a quick phone interview, is the annuities-based long-term care or the annuities-based linked benefit products. And what something like this may look like. And by the way, a huge benefit of these right here, the linked benefits products versus maybe over here, although I believe that rate stability is here with traditional long-term care insurance products, well, guaranteed premiums, guaranteed benefits, guaranteed premiums right here, guaranteed benefits. And by the way, so that's the number one concern for consumers, right? Are my benefits going to decrease? Or my premiums going to increase? Not with these, typically, not with these. I hate generalizations, but typically with these, guaranteed benefits and guaranteed premiums. The second thing is whether it's the annuity value here or the death benefit here, it is not a if I don't use it, I lose it proposition. So in short, I preface this call with talking about the two concerns over here. Why? Because those can be completely combated, completely mitigated over here, right? But let's go down to the annuities-based linked benefits products. Outside of this over here on the right-hand side, this has the least amount of underwriting right here. Usually knockout questions and a quick phone interview that goes over cognitive functionality, all of that fun stuff. This is what an annuity linked benefit might look like. You put $100,000 into an annuity. That $100,000 today that is sitting in a certificate of deposit earning 60 basis points on a 5-year certificate of deposit, national average, 60 basis points. And yes, I'm going to get some people who say, well, but XYZ bank gives me 1.5 or I work in a bank and I give 1%. That's fine. I'm talking averages. The average is 60 basis points, and that's a fact. It's the average, FDIC.com. 60 basis points is the national average on a certificate of deposit. I got my chops busted on one post a while back. Somebody said, well, but I work in a bank and I'm giving this. That's fine. I'm just talking about what the average is. And if you have a problem with the average, take it up with FDIC. But anyway, 60 basis points. That client, if he or she were to self-insure, where's that money going to come from? Probably that fairly liquid certificate of deposit money, right? What if instead you took that money from your left pocket, moved it into your right pocket, and now what you are getting is, say, in that annuity, that right pocket is the annuity, now you're getting 1.5% to 3% growth over it's maybe a 9-year surrender charge or a 5-year or a 10-year surrender charge. There are various linked benefit annuities, but you're getting a higher interest rate. And by the way, yes, there are long-term care fees deducted. Usually guaranteed fees cannot increase, deducted from that contract value in the annuity, but they're a fraction of what one would have to pay over here. But what has happened when you move that from the left pocket to the right pocket? Well, you still have that chunk of $100,000 in that annuity that is probably growing pretty well, depending on, what that long-term care cost is in the policy. You have a death benefit, which is the contract value. Usually it's 100% of the contract value is the death benefit. But what has happened to your $100,000? It maybe created a long-term care pool of $300,000. That is the benefit of a linked benefit annuity. So it may look something like, okay, you have $300,000. Now, that can be paid out over a 6-year period of time. So that's $50,000 per year, right? Those first 2 years, 50,000 and 50,000, that is the $100,000, Mr. Client, Mrs. Client, that was in your policy. But then those remaining 4 years is that extension of benefits, right? So the first 2 years is the client's own money. And by the way, that's how these are sustainable. Think of these as kind of high deductible long-term care plans. Actuarially, that is really how these are sustainable, because the client's money comes out first with annuities-based linked benefits, with life insurance-based linked benefits. The client's death benefit and cash value comes out first. That EOB is then when you start getting into the company's money, to oversimplify it. So a typical linked benefit annuity is, all right, you put in $100,000, it turns into $300,000 from a long-term care pool. You can get that paid out to you if you cannot do 2 activities of daily living for a 90-day period of time over a 6-year period of time, if that makes sense. The first 2 years are your money. When that hits 0, well, congratulations. You still have 4 years left on that benefit. Hope that makes sense. This is meant to be kind of an inch deep and a mile wide. If I confused you, certainly feel free to give me a call. I'm the CEO of CG Financial Group, Charlie Gipple here, 515-986-3065. We are a marketing organization helping agents, financial advisors, broker-dealers with long-term care, annuities, and life insurance. Thank you and have a good day.